Good morning, everyone, and happy fall. My name is Emily Drake. I'm a managing director here at Fairport Wealth in Cleveland. We're very excited today to welcome all clients in the Fairport family, which includes our Leonetti office outside of Chicago and Luma Wealth, to this year's final investment town hall. As you know, we host these webinars on a quarterly basis, and Deb Feldman and I will continue to take turns moderating. The goal of the town hall is to connect you directly with our Chief Investment Officer, John Silvis. John will recap where we've been, he'll describe where we are today, and share his thoughts on what's ahead. We've asked for your questions in advance, and John and his team have prepared slides addressing those, as well as some other frequently asked client questions. As advisors, we are in continuous contact with the investment team, and here are some ways that you can be too. You should be receiving Fairport perspectives in your email. You can subscribe to the Fairport Flash podcast on Apple Podcast, Stitcher, or Spotify. And you can follow the hashtag Investing with Fairport on LinkedIn and Twitter for weekly thoughts on the market and economy. Some housekeeping. Everyone on this call will be muted. And as much as we'd love to see your faces, your cameras are disabled. If you do have questions that arise throughout the presentation, you can type them in the questions section of your toolbar, and we'll answer as many as we can. With that, I'm going to turn it over to John Silvis, our Chief Investment Officer.
Thanks, Emily. Hard to believe, I think this is our 7th town hall since we went remote. So time flies, I guess. But you know, I titled the first group here as "Are we there yet?" And you know, I feel like the kid in the back of the station wagon asking the parents, "Are we there yet?" Because in my view, when you have a pretty good move in the markets like we've had over the last 9 months, and markets are up double digits, you kind of want to get to the end of the year and be able to bank those and move into the next year. So I kind of feel like I'm on the back of the station wagon, and I'm trying to get between here and the end of the year, but got a lot of slides to go through, and excited to give you our perspective on things. So as I said, this is our 7th one, and it's been a strange journey. We've gone through shortages on toilet paper, computer chips. I think we talked about the ketchup packets at one point, if I'm not mistaken. I drove by a car dealership today. There's no cars on the lots because of the semiconductor issue, and now we're down to the chicken wings. So even chicken wings are in short supply. I was actually in a restaurant recently, and they had a sign that used to say 10 wings for $10, and then someone put a piece of duct tape over it, put 15. So chicken wings are up 50%, at least in my town they are. So we'll keep an eye on all those things and let you know what happens going forward. But you know, equity markets remain in an uptrend. We've seen that since the low of March of 2020. As we head into the final quarter, you know, I think we're going to see further gains going into the quarter. I know we had a little bit of a correction here in September, and I'll talk a little bit about that as well. But you know, from the low we saw in March, we're up almost 100%. In fact, we were up at one point 100%. As you can see from that third column from the right, commodities are leading the pack this year. They're up almost, as of the end of the month, September, they're up almost 30%, 29%. A lot of that has to do with the price of oil. We talked about some of the scarcities before. Lumber prices were up; they came back down. They're starting to go back up again. Believe it or not, coal is near all-time highs here, or cycle highs. So a lot of commodities are starting to see that just because of supply issues and demand going forward. Third one down on that column, the year-to-date column, is large cap equities, and they were up about 16% as we finished the third quarter end of September. We had a little bit of bounce back from them. They're up about 17.4% as of yesterday. The ACWI, which is something we use as a benchmark, which is a global index, both in the U.S. and domestic, international equities, is up about 12.5% so far this year. But you know, bonds have been struggling. Bonds, as you can see here, and that year-to-date column are on the bottom of the list, which rarely happens. They're down about 1.6%. They've actually done a little worse as we head into the month of October. They're almost down 2%. So it's been a tough environment for bonds for sure. As I said, we had some give back in the month of September. You know, corrections, as I mentioned many times, are to be expected. They happen in bull markets all the time. I've given this stat before, but I think it's important here. Get on average about 5% corrections a year. We actually haven't. This is the first one we've seen in almost a year. So, excuse me. It was overdue, and we'll talk a little bit about that going forward. We usually get a 10% correction once a year. Haven't seen that since the low in March of 2020. I think it's probably unlikely this year, just because we're going into the fourth quarter, which tends to be historically stronger, one of the strongest parts of the year. So it's probably unlikely we'll see that, but that remains to be seen. That's always a possibility as we go forward. So the third quarter really, it was defined by a couple of things. One, the Delta variant picking up, and then supply disruptions, which I touched on a little bit there, and we'll get in a little more detail. But as far as the Delta variant, the red arrows you see there on the right of the chart, that's the daily new cases you see. I get that off a website called World Meter. Anybody can go out and see it. But that red arrow is where we were back in July 15th when we had our last town hall. At that time, it looked like we kind of survived the surge, survived the wave, and things were getting better. We were pretty much full reopening at that point. I know the mask mandates were taken off and all those things. Then, unfortunately, the Delta variant picked back up, and as you guys can see my cursor here, we actually had another wave. It looks like that's starting to come down, but that definitely had a dampening effect on the economy in the third quarter. I think it changed behavior. A lot of states started reinstituting restrictions, and that definitely had a negative effect on the economy. And I think it started taking tolls on people's psyche as well. This is a survey done I saw with them in Barron's a few weeks ago, and it says rate your level of risk of getting sick from coronavirus. As you can see, there's three in the middle of the page there. The one on the far left is U.S. adults overall. Back in June, people had 29% said they thought they had a high or moderate risk of getting sick from coronavirus. But as we got to the end of September, that went to 47%, so almost 50%. So definitely, I think, had some damping effect on things. I think that's, and I hate to use the term because it's overused, I think that's somewhat transitory, and I think we'll see that as we start to see those numbers come down. If you watch football on TV, people are in stadiums, so people are going back to football games, both on the college and NFL levels. So I think people are willing to go out and about. So we'll see, but that's something we're definitely keeping an eye on. Before I jump into the economy, I'll pause there. Emily, do you have any questions, or do you have any questions from anybody? Or
John, we don't. I think most of the questions are focused on current inflation, supply and demand in Washington. So I'll
Okay.
let you keep going.
All right, we got a lot to talk about there, so great. So as I mentioned, the economy definitely slowed. I think it was the two prongs that I mentioned already, Delta and supply constraints. If you look at this chart, this is the Atlanta Federal Bank of Atlanta. They put out their GDP Now survey. I've used it several times. I think it's the best real-time indicator as far as the direction of the economy, and we just finished the third quarter. They're estimating only 1.3%, as you can see down here in the lower right. A lot of people are starting to change their forecasts. A lot of the street economists are, and I think we're going to see that number come lower. And I think that's to be expected. It's going to be an uneven recovery. We're going to see. We saw it come out of the gate pretty strong, one of the strongest recoveries we saw coming out of a recession. It's waned a little bit. I think most of that is from the reasons I already stated. And I think we'll see growth pick up as we get into the fourth quarter, then into 2022, probably back to that 4 or 5% range. But it's something we're definitely keeping an eye on. I think as we get through some of these supply constraints, and I'll talk about those a little more in detail. Jamie Dimon, who is the CEO of JP Morgan Bank, the biggest bank in the world, so he has a pretty good pulse on what's happening with the economy. He made the prediction, and he says, I won't quote him, but he said he rarely makes predictions, but he's predicting that supply issues are going to dissipate by the time we get into 2022. So that's only a few months away. So hopefully he's correct on that, and that'll be a big reason why we see the markets and the economy pick up. as we head into next year. But just to give you an idea, one of the biggest reasons we're seeing issues is goods coming into the United States. We don't make most of the stuff here. Most of it comes from Asia, especially things that are manufactured. As you can see on that column on the left there, on the column, the chart on the left, those are the number of ships anchored out in Los Angeles and Long Beach, the two biggest ports on the West Coast, which bring most of the issues or most of the goods from China. And right now there's I think 67 ships out there. I think it's a record. So there's a lot of traffic out there, and there's just a lot of constraints on one getting the goods offloaded, labor issues, getting enough people to do it, and then enough containers to be able to move it. So as you can see on the right, the number of new container ship is increasing. If you go all the way to the bottom of that table on the right, the 2021 year to date, we're at new record orders for container ship. So at some point, my guess is we're going to see a glut and you might actually start to see prices fall. But in the meantime, and last chart on this, costs are rising. The blue line there is the how much it gets cost to get a container ship from Shanghai to Los Angeles, which is about $12,000. See the long-term average is somewhere around $2,000. Now getting goods from Los Angeles to Shanghai, which probably doesn't happen very often, has been pretty steady. So eventually we're going to see that slow. I think the big concern is that's going to likely be passed on to consumers at some point. And to Emily's point earlier, that's going to be an issue with inflation. We saw numbers come out today. I'll talk about those in a second. But I think, on a positive note, Evercore ISI trucking survey, which if I had 3 or 4 charts to look at once a month, this would be one of them because it has the highest correlation to GDP growth, and it's at its highest level since 1997. So I think overall the economy is still in pretty good health. We did have a stumble here. Again, I think those things are to be expected as we come off of what is probably not a normal recovery with all the other issues we're dealing with. So I think growth going into 2022 still looks pretty good. I think it's going to firm up as we go forward. Again, just to reiterate that the company surveys still remain above that 55 level. Somewhere between 55 and 60, you tend to see GDP growth one quarter out, somewhere between 3 and 4%. And that's kind of right into what expectations going into the fourth quarter. So I think we're going to see better the economy pick up, better numbers coming in as we get through this supply constraints. But again, it could take more than a couple quarters, but it seems like as we get into 2022, it's going to start to alleviate itself. On the job market, it's still in recovery mode. Unemployment dropped to 4.8%. I think if you go back a year or two, most people were expecting us just to get to 6% unemployment would take us several years. We got to 6% pretty quickly, and we're 18 months into this recovery, 15 months into the recovery, and we're already below 5%. So, I mean, for most people, that would be considered full employment. The JOLTS number, which is the job openings number, is at 10.4 million, the highest it's been on record. So there's plenty of jobs out there. And, I think as unemployment benefits have run out, people will start to return back to the labor force. So I think there's going to be more people entering the labor force going forward, and that's a good thing. But how good is the job market? Well, it's so good that there are no layoffs to announce. So this is this is a 13-week moving average of the employee layoff announcements. As you can see, what goes up must come down. So as we went into the recession and the shutdown, there was a ton of layoffs being announced, historic numbers, and those all have come back. So the economy has been really resilient in this area, and I continue to think, as I said many times, economic expansions tend to last anywhere from 5 to 10 years, on average 8, and we're only in basically halfway through, not even halfway through the second year. So I think we have further upside to go. Consumer net worth, again, equities, housing prices, and bank deposits drive net worth, and they are all heading in the right direction. So the consumer is in much better shape than they were a year ago, which I think is why I think we'll see another surge in the economy. If you want to call it reopening 2.0, however you want to define it. I think as we get as we continue to see the caseloads come down, more people get vaccinated. I know that's slowed, but continue to get vaccinated, and or people get the second booster or get a booster. I think those are all going to be positive things moving forward. So inflation does remain a major concern. There's one big issue out there that's causing concern for us. It's the stickiness of inflation. The words that term transitory, and how fast will it revert back to pre-pandemic levels. It's probably going to take longer than people think. The beauty of it is that Chair Powell's never really defined transitory, which is great for him. But this is a forecast from Blackstone. As you can see, we're that I'll call light green color at the top, with the highest inflation. We just had CPI number come out today, and it was a 5.4% year over year. Inflation without food and gas, which what they call core inflation, was about 4%, and that was steady from last month. So I don't know if we're peaking yet, but we're probably getting close to that peak. They still think at Blackstone that we'll see inflation above 4% probably for a good part of next year, and then we'll start to see it go down. But they think that long-term trend, which a lot of people think is somewhere between 2 and 3%, not closer to 1.5 and 2, what we've seen over the last few, last 10 years. Again, I don't think 2.5 to 3% or 2.5 to 3% inflation is a major concern for the economy, but that remains to be seen, and we'll see that as we head into next year. So that's kind of our thoughts on the economy. I think overall, we still think we're in the beginning of that economic expansion. We'll see some slowdowns here and there. Most of it's going to be pandemic driven, but we still have a positive view. So before I shift to the markets, Emily, I'll pause there and see if you have any questions, or if you have any wisdom you want to give us.
I never have as much wisdom as you do, John. Just to be clear on the inflation front, your thought is that it's pretty much baked into the market, or do we think we're going to see further pullback with the concern on inflation?
Well, I think there's always a headline risk to that. Like for example, CPI numbers came out today. They're pretty much what was expected, so it wasn't really a market mover. But I think we're going to see those things, especially when you see issues with supply constraints and or labor costs going up. And I know, like a good example, John Deere, a pretty big company, is having some labor issues. The union wants higher wages for a longer period of time. That's, at the end of the day, you would assume would be inflationary at some point. So I think you're going to see those headlines. But I think big picture, I think probably the biggest move in inflation is probably behind us. And I think, I don't want to say it's totally baked in the market, but I think the market expects the levels we're at. If we stay at these levels, meaning 4 or 5% for much longer than people think, and several quarters, I don't think that's baked into the market. But we'll see that as we move forward. I'm a believer of that 2.5 to 3%. Even at 3% inflation, it's not as big a concern, and I don't think that's going to be a negative impact on the market. So, the markets have taken most of these numbers in stride. As I mentioned at the beginning of the webinar, we're up 15, 16, 17% over the last 9 months. So you could argue it's kind of baked in at this point.
Mm-hmm. Thanks. Other questions are really related to what's coming out of Washington. I think you're going to cover that.
So we'll cover that. Okay. All right, great. So the markets, as I said, we've had a positive year so far. If history is a guide, we should see further gains as we head into the new year. This is a chart from LPL Research, and basically goes back. The third quarter was our 6th consecutive quarter of positive returns. So again, going back to the second quarter of 2020. In history, would tell you, usually when you see 6 quarters of positive returns, that's hard to say. The next 6 months tend to be pretty good. So I have a red circle there. There's 7 other instances of this since 1950. Every one of them was positive 6 months down the road, and the average return was somewhere around a little under 8%. The median was 6.6. So I think the lowest was 2.4 and the best was 19.4. I don't know, we've fit in that range, but I would tend to think we have somewhat of a tailwind behind us. And as I mentioned to Emily yesterday, I heard an interesting fact that in bull markets, and we're definitely in a bull market currently, you tend not to make the high of the year in September, which September 2nd so far has been our high this year. We tend to be made in the fourth quarter, usually in November or December. So my guess is we'll see a little further return. We could see some pullback in the short term here as we get through some of these Washington issues, which we'll talk about. But I think the backdrop looks pretty good going into year end. And although I think 2022 can be a positive year, at some point I think we're starting to see that now. Returns will be a little bit more muted. They tend to be very good right off the bottom, like we saw last year, and then in the beginning of this year. And then I think you start to see slower positive returns going forward. So I think we'll continue to see that. On that note, valuations have come down. It's been one of the big arguments for people that think the markets have moved too fast, or valuations. As you can see, that gray line, you move to the right of the slide. We finished the month of September about 20.3. That's actually back up a little bit because prices have moved up, so we're about 20.6. But it's always been our belief we're going to move back towards that 20 times earnings sometime by the end of the year. I didn't think we'd get there, to be honest with you, as we were in the middle year, because it was kind of not moving. But again, at 20 times earnings, if you look at next year's earnings in 2022, I still think that sets a pretty positive backdrop going forward. So we do think valuations will come down, but I think it's going to be measured and offset by gains in earnings. Speaking of earnings, earnings continue to climb, but they have slowed here a little bit. So today is really the first day of the earnings season for the third quarter. JP Morgan and BlackRock, two of the bigger financial firms out there, reported earnings this morning. Both did better than expected. BlackRock was up, I think, 13 or 14%. JP Morgan was up almost 20% better than what people expected. So it beat expectations by high teen percentages, and that's over an expected increase from last year already. So far looks pretty good. I mean, we got a lot more companies report. It'll be pretty hectic over the next probably 2.5 weeks, but I think you'll see better than expected earnings in the third quarter, and then I think the comps get a little harder going forward. But we'll follow that as we get there. But equities were definitely oversold in September. So what caused the correction, if you want to call that, the 5% pullback we had, was mostly the rate of the S&P was near highs, and you can say it was overbought. So history tell you when markets are overbought, they tend to get oversold, and then they go back and forth in a cyclical pattern. So as we got to the close to the end of September, this is back to September 20th, 63% of the names in the S&P, so over 300 names out of the S&P 500, were at 20-day lows. Now in an uptrend, that's okay. In fact, it tends to happen, and it's actually kind of healthy, because if you look at the forward returns after that, so anytime you get 20-day lows above 50% or more, and we were at 63, if you can see in this column here, returns going forward, 120 trading days, which is basically 6 months, are about on average about almost 11%, versus on all other observations about 4.5. Same with 1 year, they're up almost 18%. Now, again, I don't know if we'll see 18% over the next 12 months, but it does kind of paint a positive backdrop going forward, which I do believe we're in. So we talked a little bit about inflation. So I guess the other side of that is interest rates. So interest rates are moving higher. That's not much else to be said there. We saw the 10-year Treasury break through 140, which was a big number there for a while. It actually broke through 160, which was kind of the next level of resistance. A few days ago, I think we came back down below that. But our view is rates will continue to move higher, probably more at a measured pace than a frantic pace. But I think we'll see that continue, and not just on the 10-year, but really across the board. It's a little harder to read, but this shows you the 30-year Treasuries, which is the blue line there, the 10-year Treasuries in the middle, which is the black, and then 5-year Treasuries, which are the red one on the bottom chart. All three are moving up from lows earlier in the year. I think we're seeing that move across the yield curve. I think we'll continue to see that. resistance on the 10 years probably around 175. If we get through that, the next one's probably closer to 2%. So those are kind of levels we're keeping an eye on. We did break that 160. I don't know if we'll see 175 before the end of the year, but I think that's kind of the next spot will be. Time will tell how fast we get there. So I can keep going here, Emily, or if you want me to pause before we get into the portfolios, that's up to you.
Sorry, I was muted. I have a really good question, but I also, think it would be interesting to ask everybody on this webinar what their first mortgage rate was.
I had a chart for that and I took it out because I had too many charts. Not a mortgage rate, it just shows you we are 30 years, it was September 15th maybe, 30 years ago, the 10-year treasury yield hit its high. I think it was 15 point something. And I've heard many stories. Luckily, I never had to do this, but I've heard many stories of people getting mortgages at 15, 16, 17% back in those days. So yeah, we
hard to believe.
30 years ago, yeah.
So we do have one, I think, a really good question here. It's are there sectors or types of assets that do better in high inflation and a high tax environment?
So the best hedge against inflation tends to be equities in the big picture. So if you're looking to hedge against inflation, and I showed you some of the numbers recently, so inflation is 5.4% over the last 12 months. Stocks are up 15% or more, and bonds are down close to 2% over that time frame. So just to kind of give you an idea. So I think big picture equities tend to be the better bet. I think the ones that tend to be more and more sensitive, financials are probably the best one to be in. And I'll just move to the next slide. So we've moved to an overweight in financials. So financials tend to be a good area, and some of the cyclical areas as well tend to do well. It's a little mixed. It depends on what the backdrop is and why the inflation's picking up. So there's not a real consistency to that, other than banks tend to do better, especially when the yield curve steepens, because they can loan the money out at lower rates and then or pay lower rates on deposits and lend it out at higher rates. So they definitely benefit from that. But overall, I think equities tend to be the best hedge there. You can pick and choose, and sometimes you do better, but a lot of times that has to do with the backdrop of what caused the inflation. So, so I was talking about our sector weightings. So there they are in front of you. Haven't really changed much. We definitely have a cyclical bias, as I've mentioned a couple times this year. We're overweight materials, industrials, financials, the top three there. Those are all tend to be cyclical in nature, and then discretionary and technology as well. On the flip side, if you look to the bottom, we're underweight utilities, staples, and those tend to be defensive in nature. Now energy, we have been underweight. Something, to be frank, we probably missed on the way up with one of the better performers in the first and second quarter. But something we're keeping a close eye on. I know oil's at $80 a barrel, I think today, or was yesterday. More and more people, analysts at JP Morgan, thinks we can see $100 oil in the not too distant future. So if you asked anybody at the beginning of the year, $100 oil, I don't think anybody would have said they would expect that. So that's been one of the areas that has been doing well, something we're keeping a close eye on. I don't know how much is already baked into the equity markets or the equities in energy, but something we're keeping a close eye on. Value and small caps are kind of making another run at leadership. It's been a choppy process here, but if you go back to the low of last year, we had a big run up in value that kind of petered out. May of this year, we saw a move back up in growth. Looks like value's trying to take another stab at leadership here. You could say the same thing about the chart on the right, which is small caps. I'm a little skeptical on both, but small caps tend to do really well that first year, and then they tend to lag after that, and kind of that second year of the recovery. So it wouldn't be the normal trend, but something we're keeping a close eye on. Haven't made any changes in our view yet, but it remains to be seen if either one of those will really make a move on leadership in a meaningful way. Seasonality, it's another one of those tailwinds that we have behind us. That red dot, if you can see it, we were down here in September when we had a correction, and this, if you look to the right on this scale, is how much you would expect forward returns over the next 3 months to be. So as you get into September, August, I realize this is a kind of a hard chart to follow. Returns tend to be somewhat muted. As you get into the middle of October and into the end of the year, they tend to do very well. Again, that tends to be August, September, October tend to be the worst months of the market, and November, December, January tend to be the best months, which lead into the fourth quarter. Not surprising, but I think we're into that seasonal space where we should see some tailwind behind us. And again, if you haven't already figured this out, we remain constructive on equities. I realize we're going to see some corrections. We saw one. We could technically still be in the current correction, but I think big picture, as earnings come out here and the economy tends to reassert itself, I think we're going to see positive returns going forward. So I got the last thing called the home stretch, and this is we're in the last 3 months of the year. A lot of things are still out there. I know you said you had some questions on Washington, and I think from my view, that's kind of where most of the focus is going to be over the next, probably at least the next 2 months into November, early December. So I'll pause there, Emily, if you want to throw the questions out maybe now, and I'll answer them as I go through.
Hey, John, I think you're going to cover those questions, so I'll let you go on with the presentation.
Right. If I don't cover them, you can bring them up at the end.
Okay.
All right, fair enough. So as I mentioned, a lot of people are calling it the September to remember, but I think Congress more or less punted the ball in September. So one of the big issues we had was, I'll go through the slides, for the budget, the debt ceiling, Chairman Powell's renomination, tapering, all these things, and most of that's been Washington-centric. So as you can see here, as cases were rising, President Biden's approval on handling COVID has been falling. If you go back to February, really right after the inauguration, he had a net positive of 32. If you go to the right side of that chart, it's now a -2. So that's a pretty big delta between call it the last 6 or 7 months. I think it's been a tough thing. Problem with President Biden is it's hurt his what they call his political capital, and I think as his poll numbers go down, and they're not catastrophic, but as they go down, he tends to have a little less sway with some members of Congress, especially being the tug of war between the progressives and the moderates. But so as I mentioned, the debt ceiling and the budget were kind of punted. We're going to re-examine those things in December. I'm sure you hear the word fiscal cliff a lot of times between now and then. So they did a continuing resolution or a CR, which pushes the budget to I think December 3rd. And the debt ceiling's likely late December. It could be stretched out to early January. So my guess is this will all be packaged in some type of deal that's made sometime in the fourth quarter. But these are the betting odds for the reconciliation package. The other thing that's been unresolved is the infrastructure. The current administration has broken that into two. One is called the physical, which is a $1.2 trillion bill, which was passed in the Senate, which would likely pass in the House, but they don't want to put it to a vote, or haven't put it to a vote. And then, which the president already said he would sign. And then the second part of that is what they call their human infrastructure, which is basically all the programs that President Biden wants to, ran on and wants to put through. And there's a litany of those, but that was price tag was at 3.5 trillion. Most people and the president himself thinks it's going to be closer to 2 trillion when it's all said and done. There's been a lot of tug of war in Washington. Who knows where it's going to end up? But as you can see here, go back last week, there was a poll and predicted early a betting site, and people now think it's going to be less than 2 trillion. I don't know. 2 trillion seems like a lot of money to me, so we'll stay tuned. But so that's another issue, and along with that, you're going to see threats of shutting down the government, threats of not passing budgets, and the markets will react most likely negative to those things. They tend to be short term, so I'm not too concerned with the big scheme of things. I think we'll figure most of those things out. It'll cost us a lot of money, but they'll figure it out. The second thing, and I would call this somewhat Washington focused is the taper tantrums. So the Federal Reserve has been buying $120 billion worth of bonds every month, really going back to March of last year. At some point, they're going to stop doing that. Chair Powell has indicated that it's likely to happen in the fall. Didn't really commit to a time. It seems like November is the most likely process, and it'll be go into the middle of next year, 2020. So call it an 8-month process. We don't have a lot of data points on this, but we do have one. If you go back to 2013, we had what they call a taper tantrum. As the markets, as they started to begin tapering, we had a couple pullbacks, volatility along the way. I don't know if the last 5% pullback or close to 6% pullback was part of the beginning of the tantrum, because it kind of coincided with when he announced that they're likely to do it. But it's something we're keeping a close eye on. The bigger picture, though, if you go back and look at that time frame on this table in front of us, you see the yellow highlighted areas. The S&P last time was up about 10% during that time frame. So it does add the volatility. I'm sure you'll see pullbacks along the way. But if you look at the one data point that we have, it didn't really have a long-term effect on the economy. I'm sorry, on the equity markets. The last one I'll show. We always like to look at things long-term and look at the markets on a long-term basis. So we had the 20-year anniversary of September 11th, and the people at ISI, or Evercore ISI, put this out. I thought it was interesting just to kind of give you a bigger perspective on things. Nominal GDP grew from $11 trillion to $23 trillion over the 20-year period. The S&P went from 1,100 to 4460, which was up about 4 times over that 20-year period. A lot of things happened, good and bad, over those 20 years. But again, I think the resiliency of the economy and other markets are pretty impressive. And then the S&P, as you can see, the earnings grew 140 on an aggregate basis to 210, and we're probably closer to 230 at this point heading into 2022. So existing house prices, so everything kind of went up. The one thing that and this goes back to Emily's comment about mortgage rates 30 years ago, the bond yields were at 4.7% in 2001. They're 1.4, I think they're 1.58 today, but have gone down. So just kind of put things in perspective. As I say, the economy's been resilient over the last 20 years, and as we see the economy grow, that tends to be good for earnings, and that tends to be good for markets. And I think that's going to continue as we go into the new year. So were there questions on watch that I didn't cover? I avoided taxes on purpose because I just don't know. And there's enough people in our firm, as you know, Emily, that I would punt the ball to on taxes. I think if you ask them, I think they're going to go up. That's about all I'll say. How much, I don't know.
Yeah. So one of the things that you've often said is the fourth quarter is generally one of the best quarters. And but if we do anticipate a raise in capital gains tax, do you think we'll see some big sell-off and people taking their gains this year versus next year?
Well, yeah, that's a good question. I guess you never really know until it happens. But as we've talked about before, and it's been fairly transparent, this process. I think the president's the one that would concern me more would actually be the corporate taxes, because that's going to have a bigger impact on earnings. And I do think earnings in 2022 will have somewhat of a hit because of higher corporate taxes. I think they're going to go from 21. I think the president recommended 28 at some point in the campaign. He's been talking to senators like Senator Manchin from West Virginia. It's probably going to be more like 25 or 26. But how much of that's baked in already, I don't know. But I think we'll see higher corporate taxes. That's a concern for the markets, I think, especially if it's higher than that 25 or 26. If we go back to the 28, I think that's not baked in. As far as the capital gains, again, they kind of put numbers out there. I don't know them well enough to speak to them, but I think that what the expected increase is kind of a known quantity. If it gets higher than that, or they tack on some other additional tax, then I think that might be a concern. I don't know. I think I guess I would kick it back to some of our advisors. I don't know if people would try try to anticipate that and take games earlier this year than next year, or take games that they don't really plan on taking at all anyway. So I'm not sure how much effect that would have, but it could have some effect. I think we're going to have some jockeying in Washington over the next 2 months, maybe 2.5 months. These guys like to go home and campaign. So my guess is they'll figure everything out by early December so they can hit the campaign trail and go back to their constituents. And most of those numbers will be figured out. If they're in the ballpark what's already been expected, I don't think there'll be much of a change. Luckily for us and luckily for our clients, there's not a lot of capital losses to take at this point this year. So we normally don't change here and try to take gains at the end of the year. So that would be a little different for us, but I guess it's possible.
Okay. Thanks, John. Well, I will say that we're keeping a close eye on Washington, and you can expect us to continue to update you, either through videos or webinars or from our emails. If you did have questions that we were unable to get to, someone from the investment team or your advisor will reach out to you directly. I do want to take an opportunity to invite you to join us on November 3rd for, I think, a very special virtual cooking class with Chef Brandon Krastowski of Edwin's. You can RSVP via the email invitation or by calling 216-431-3000. This food-centered event shines a light on our community beacon food banks, the Northern Illinois Food Bank, and the Greater Cleveland Food Bank. Since we can't physically be together, it'll be fun to cook together or maybe just watch someone else cook while you drink a glass of wine. I encourage you to sign up and feel free to forward that invitation to friends and family, as I'm told that the sky's the limit. So let's get as many people in there as we can. We thank you for joining us today. It's always a privilege to inspire you and your families, and we do feel sincere gratitude for your trust and loyalty. Please stay safe and be well.